everyone, welcome to our channel where we help your real estate investments work harder for you. I'm Samantha from Elevate Realty. In another video, I talked about active things you can do to a property to boost returns. Now, you might not think those strategies are for you simply because you don't have the time or the expertise to get it done. So in this video, I'm going to share 3 strategies that you can do to get better than market returns without doing any value add work. And even if you think you can handle value add work, you can actually combine these strategies together so that you can get even better returns. So if you want to learn more, then keep watching. Okay, let's dive right into things. The first strategy is location, location, location. And I know what you're thinking. You already know this. But when I refer to location, I'm not just talking about how good a location is right now, but to focus on properties that have a higher growth potential because they're in the early stages of gentrification. I'm talking about neighborhoods that might not be so nice right now, but there are redevelopment plans in the works so that they're more likely to improve in the future. Now, gentrification can begin with government initiatives such as new transit lines that can make an area more accessible. One example of this in Toronto is the Eglinton LRT that is underway. If you live in Toronto, I'm sure you're well aware of this, and you've probably even seen this meme. The good thing about the LRT construction is that once it's done, it'll be a lot easier to get around Midtown, and properties close to the LRT will attract more buyers and renters. Now, gentrification can also come from the private sector, such as major condo projects with master planned communities. In these projects, developers aren't just building condos, they're also creating a new community complete with retail space, office space, trails, and green spaces that will attract a new and better demographic. As you can see, both public and private developments can contribute to the improvement of a neighborhood. The key to the strategy is to choose properties in a neighborhood that are in the early stages of gentrification. While the neighborhood gentrifies, you'll have to be patient and sit through years of construction. But once these projects are done, these properties will be able to attract a new crowd who is willing to pay more for a more convenient location, better amenities, and better neighbors. In the end, you'll see a big bump in the property's market value, and you'll realize a much higher appreciation compared to the rest of the city. The second strategy I want to talk about is not to focus on commoditized properties. And yes, I probably made that term up, but I'll explain. When you look at condos in Toronto, there's a lot more of them on the market, and they're pretty similar in terms of age, layout, and size. And it's not just condos. Many newer residential communities, especially in the suburbs, are pretty cookie cutter. They're nice and there's nothing wrong about them, but they just all look very similar. Because of this, they're more like a commodity, and it's a lot easier to figure out how much a property like that costs since you can compare them apple to apple. Now, on the other hand, Toronto's houses tend to be older and they're somewhat unique in terms of their size, layout, parking design, condition, and age. So when you zoom into a community, it's very possible to see nothing sold in the past few weeks. When you're comparing numbers from a few months back, they probably won't be very good comparables. Now, on top of this, these properties might not be the same in terms of condition, size, and parking situation, so it's a lot easier to misprice a house if you're not experienced. For the experienced investor, this is a great opportunity. On our end, we spend a lot of time looking at properties on the market for sale in Toronto on a daily basis. So after we shortlist properties that we think are good, we analyze them based on recent data and trends to see how their returns stack up. Now, because of this, we can also say we're one of the quickest at finding properties on the market that aren't priced properly so that our clients can act on them. Now, if you want to do this yourself, it's possible, and here's what you need to know. We recommend that you focus on unique properties, and you really need to spend time to analyze and understand the sales and rental markets in different pockets of Toronto. This will help you find properties that are at a better discount, which means there'll be better returns for you in the long run. The final strategy I want to discuss is really more of a fact that not everyone knows about, and that is not all types of properties in Toronto have the same rates of return. As you move up to more expensive types of properties, condos to single-family houses to duplexes and triplexes to commercial properties, you'll see a better rate of return from rents. And I'll use condos and houses to illustrate my point. Because condos are the cheapest, they have the lowest barrier of entry, and as a result, they have the most buyers. Now, unfortunately, that's not to your advantage. This means that even if you find a good deal, it'll be harder for you to get the deal. And there's also a lot more speculative buying, which creates an environment where condos have a much higher purchase price per square foot compared to houses. Now, even though buyers are willing to pay a higher price per square foot for condos, you don't see this as much in the rental market. So what I mean is that the rent per square foot of a condo is really more or less the same as the rent per square foot of a house. Now, since a house has a lower purchase price per square foot and a similar rent per square foot, it is a much better investment compared to a condo. Let's look at some actual numbers in today's environment. As a reference, we're in the middle of 2020. Right now, the entry one-bedroom condo in Toronto can cost around $500,000. After you buy it, if you rent it out, you can get $2,000 a month, and monthly operating expenses are around $600 a month. So this means that your annual operating income would be $16,800. One way to compare returns on income properties is take the operating income and divide it by the property's market value. We refer to this as the cap rate. For this condo, the cap rate is 3.4%. Now, let's look at a house in Toronto that costs around $900,000. If you rent it out for $4,800 a month, combined with monthly operating expenses of around $850, your annual operating income will be $47,400, or a cap rate of 5.3%. As you can see, the cap rate on the house is much better than a condo, which means that you'll get a much better return on your rents. So basically, the bottom line is, if you can afford it, go bigger. All right, I've just shared 3 practical strategies that can get you better than market returns, even if you don't do any value add work. Again, you can pick and choose which ones work for you, or you can stack them up and your returns will look a lot better than the average real estate investor. Now, please subscribe to our channel if you want to see more real estate investing videos like this one on a weekly basis. And finally, if you need help with real estate investing, feel free to reach out. I wish you all the best in your real estate investing journey, and thanks so much for watching. See you in the next video.